Hi folks, David Waring here again with InformedTrades.com and today's lesson of the day. In our last lesson we continued our course on futures trading with a look at the different components of a futures contract that it's important for traders to understand. In today's lesson we're going to continue this discussion with a look at exactly how futures contracts are traded. So let's get started.
Up until relatively recently, futures contracts were all traded via what is referred to as open outcry or pit trading. For those of you who have seen the movie Trading Places, you probably remember the end of the movie when Dan Aykroyd and Eddie Murphy make a fortune by buying and selling orange juice futures in the commodity pits. For those of you who are not familiar with what open outcry trading looks like, I've included a link below this video on Informed Trades where you can see for yourself. This method of trading is referred to as pit trading because floor brokers, who are responsible for executing customer orders of the firm they work for, as well as floor traders who are trading for their own accounts, stand in a multi-level pit when conducting their trades. The fact that the pits are multi-level, combined with the fact that they are circular in form, makes it so that the pit traders are all facing one another, and multiple people can be seen from each position in the pit. The term open outcry comes from the fact that the trading process is conducted via hand signals and shouting across the pit, which is how brokers with orders to buy and brokers with orders to sell, as well as floor traders who are doing the same, come together to ultimately place a trade. While this process looks very chaotic in nature, there are many rules and regulations in place surrounding how pit trading is conducted, so that the process of two floor traders coming together on a price is actually pretty structured. With the advent of the internet, electronic futures trading was introduced, where buyers and sellers are matched electronically instead of in the traditional style of pit trading that we have just discussed. Because of the efficiencies created by electronic trading, and the opinion by many that electronic trading creates a more level playing field for market participants, most of the world's major futures markets outside of the United States have gone completely electronic. While electronic trading has grown in popularity in many of the U.S. futures markets as well, open outcry trading is still the primary method of trading for many of the U.S. futures markets and probably will be for some time to come. Because of this, it is important to know when you are trading whether you are trading in a completely electronic market or whether your order will be sent to the trading pit for execution, something which we will discuss in later lessons. That's our lesson for today. In our next lesson, we will look at how individual traders who do not have access to the floor of the exchange execute their orders, so we can better understand the process and entities involved in executing your trades. As always, if there's any questions or comments, please feel free to leave them in the comment section below, and good luck with your trading.